Dr. C.K. Narayan joins us as he does each Monday to give us his chart check. Dr. Narayan.
Well, for stock check today, what I'm about to do is look at the relative performance of certain stocks. First up, I'm going to check out what's happening currently in Dr. Reddy. I think if you look at the chart which is on your screen right now, that shows many of these pharma stocks. The line on green, which is on the top, that is the line which depicts Dr. Reddy. And you can see that over a, let's say, multiple month period, Dr. Reddy has been clearly outperforming its other peers, which generally are these Lupin, Glenmark and Sun Pharma, etc. Now, all this was okay because they were all going around similar ranges. And then we had recently this news flow, which was, victory in the US courts, and which was which is more specific to generic drug companies. But since they won the case, I think there has been a revival of interest in Dr. Reddy. And now you can see on the chart towards the ending part of it that the trends in Dr. Reddy are beginning to run away. And if you look at the chart, which is not shown here, but on the chart, Dr. Reddy at this current price of about 2,700 has shown a clear breakout of a very long period range. Now, range breakouts which happen with huge volumes and supportive momentum are generally likely to last for a longer time and bring about substantial amount of price gains. And what we saw in Dr. Reddy in the last week was a very high volume gap up trade. And this was on the back of news. And it didn't really make too much progress on that day. But then it never considered that, the gained ground. So a lot of old positions were happy to get out because this is all happening at the top of the range. And since this is a news of a more long-lasting nature, I think that is going to propel Dr. Reddy even further. And there should be a lot of, switch over buying into Reddy. So we are clearly seeing this chart, the earlier chart which was shown you. That is a chart of Reddy versus the rest, and there is clear signs of outperformance. And given the situation on the chart, I would think Dr. Reddy could probably progress towards about 3,100, which is what is coming up as the range-based target. Now that leaves you with sufficient amount of room from the current prices, say about 20-25% upside from where we are currently. So I think that's a stock for us to really concentrate on at the moment. Moving on, the second stock that I would want to look at in a similar sort of relative basis would be HEG versus graphite. Now there is hardly anything to choose between the two stocks as far as fundamentals are concerned, the numbers are concerned, capacity, you name it, any parameter you choose, they are very, very similar. So it's no surprise in seeing that the stock prices have moved in a very similar fashion. But if you look at the later part of the chart, the red line actually depicts HEG, whereas the the blue line is graphite. We are seeing that HEG is now tending to outperform graphite as we move along. And there was a minor blip in the last week because of that news which came about, the cost of expansion, etc. But that is still not really denting the trend for HEG. So if you must invest into any of these two stocks at the current level, HEG still continues to hold on, the kind of edge. And I would think even from the current prices, you have room for about 20-25% upside for HEG from here. Graphite also packs a similar kind of punch, but if it is to be a toss-up between the two, I would say that the market is actually betting right now, and betting a little more on HEG's prospects rather than for graphite. The current news flow may be a small bit of dampener, but I think the management came out and gave some explanation. I expect a 35% upside in HEG versus about 25% in graphite.
Okay, let's take this discussion forward then. We've got with us Gautam Sinha Roy, Fund Manager at Motilal Oswal AMC, joining in on the show. Gautam, hi, morning. Don't know if you really track this space closely, but just, word coming in from Dr. C.K. Narayan on the charts for names like an HEG. Do you believe there's more steam left when it comes to graphite as a story? Because these stocks have already done really, really well year to date.
Yeah, they continue to do well. I think it's a function of the China demand-supply situation. A lot of the positives are obviously already in the price, but clearly for this sector, this very small niche sector, which has really come into prominence over the last 2 years. Things continue to look rosy. So we continue to remain bullish on the sector per se, but have to remember that most of the positives are there in the price. So it's not like you should expect multi-bagger returns from here, but continue to like the sector per se.
Right. Gautam, how are you preparing your portfolio for the uncertainties that lie ahead, which can make the markets a bit volatile? Whether you're looking at the OPEC meet or the Brexit vote on the global front, and then, when we start off 2019, the interim budget, local election results, there's so much on the plate from an event standpoint that, as a fund manager, what's the positioning you would take?
I think more than as a fund manager, from an investor perspective, because there is a lot of events which are coming, there's a lot of volatility which could be induced in the market because of these events. Most importantly, the state election results which are due early part of this month, and then expectations around global events like trade wars coming down, global growth coming back into the fore. So there are a lot of things happening, there's a lot of volatility. So I think from an investor perspective as well as a fund manager perspective, it makes sense to take advantage of volatility when it is in your side. So essentially, if you see some good corrections in markets and individual stocks, like what we had seen through October, because October was a month where FI selling was one of the highest ever on a monthly basis. And those kind of opportunities one has to really use to build up allocations. So it's important always to have a buy list ready, the stocks that you really like, and whenever such opportunities are presented because of global factors or even transient slowdowns, like we have seen slower auto sales numbers coming in for the last 3 months. So if you really like those stories on a long-term basis and you find that near-term numbers are giving you that opportunity to build a position, that is what one should be doing. And this holds more for investors, because if you see the overall construct of the market has been expensive, and the investors, if they get this kind of opportunities, that is when they should be able to come in and get better returns in the future. Having said that, the disparity between large cap and mid cap valuations has corrected quite a bit this year. So when we started the year, obviously we had high valuations across the board, more so in mid caps. Through the course of the year, what we have seen, and that's good for both us fund managers as well as investors, is that mid cap and small cap valuations are a lot more reasonable. So if you want to deploy fresh capital in that space, you can look at that. Even on the large cap side, because earnings have started catching up, there's more broad basing of earnings with sectors like IT recovering, pharma bottoming out, corporate banks bottoming out. I think the choice of sectors that you can invest is broader, and especially in an environment where the global growth uncertainty is lesser now after the so-called truce in the trade wars between China and the US. Yes, even the globally facing sectors like the commodity sectors like metals could continue to look interesting. So the risk of global growth, which was going very high, now seems contained for the time being. But yeah, net it should be a buy on dips kind of a strategy.
Okay. Where else, Gautam, do you find interest in the market, and where else do you find value? Because a big segment of the market is still struggling at 52-week lows, largely the mid and the small caps, and very selective recovery even within large caps, while the sector rotation is also playing out.
Yeah. So this has been the year in which, there has been generally not much of returns, right? It's been a very sluggish year, so to say, but within the overall construct, there has been rotation of sectors, right? And that's healthy too, because till last year the growth was, the stock price appreciation was being very selective in a very few sectors, mostly consumption facing sectors. This year even the investment side of the economy is kicking back into the action. Even the export side through IT and pharma has only been a bottoming out story. It's not really given returns yet. So the export side through IT, which is the most chunkiest export story India has, that has also come back. So I think from that perspective, investors have a lot more options to choose from to get decent returns. Going forward from here, I think even IT services continue to look interesting given the growth rebound, the very decent capital return policies that they have, and the valuations are not very expensive. Plus, rupee devaluation has also helped them. So all these things make IT sector continue to look good. I think domestic large private banks continue to look to get market share, right, both on the asset side as well as the liability side. So as long as you believe in some of these banks and their lending practices and they are available reasonably cheap, they could be good names to look at. This year, I think because these stocks have not performed very well, the valuations levels are also quite decent right now as we look at them. The other thing that we'll be looking for, of course, is the CASA side, the liability franchise being very strong, because today the asset side is not a problem. You can grow at a very healthy clip on the asset side, but if you can fund it through low-cost liability, which is sourced in a very granular fashion, that definitely is a great competitive advantage to have in this environment, especially after the IL&FS kind of crisis. So I think that's one space which continues to look pretty good. The demarcation between corporate and retail banks is not very high truly, because even if the so-called corporate banks, now if you look at the book composition, 50% plus is retail on the asset side, and they have very granular retail liabilities too. So that demarcation is not very strong. Of course, some of them might be available very cheap because of the old NPA issues, and they're coming out of those issues. So from that perspective, from a turnaround perspective, these stocks also look interesting.
Give us your sense, Gautam, on how you would be looking at exposure in financials. I know you've given just a broad sectoral call, but the risk associated with financials, there was an article this morning talking about how essentially credit extended out to MSCs has fallen over the last 12 months. Does that make the entire lending culture a bit more cloudy when it comes to the banking space, a bit more guarded actually, more than cloudy, because there are stronger channel checks that are being put in place? And in that light, how do you see the credit growth story? How do you see the impact of that on the financial performance of these banks?
So that's a very pertinent one, Tanveer. Actually, through the course of the last 3 months, I think for Indian investors, that's been the most important thing occupying our minds, especially given that the largest allocation in our portfolios are financials, especially the lenders, right? Both banks as well as NBFCs. So what I have, doing my research, what conclusion I have to come to is that you have to separate the wheat from the chaff, and that process is actually on in markets. If you see, till like 4 months back, all financials were, almost all other than the ones with the bad corporate books which had been discovered in the last 3 years, I think most of the financials were doing well, whichever were generating very good growth and delivering very superlative numbers. Now one has to be particularly careful about the quality of lending that's happening, the granularity of the lending that's happening, and the liability franchise, the strength of the liability franchise that is there. So when we meet these companies, when we do our research on them, the key questioning is along those lines, especially on the asset quality side. Are there any hidden risks lurking beyond, just beneath the surface, which market is not seeing now? So one has to be very selective. I don't think it's going to be a systemic problem. It's still not a systemic problem. It's not a problem of over leverage at the household level still. But yes, in pockets there has been overlending, probably in some pockets in SMEs or maybe in MSMEs too, as you mentioned, and that's something that's getting highlighted now. But the demand or the need for credit is also there, right, in some of these spaces, be it MFIs or be it MSMEs. So someone has to fulfill that need, but one has to make sure that while the banks or NBFCs are fulfilling the needs, they are doing the credit evaluation and the recovery process very stringently, and that's the main thing that we have to look for. Unfortunately, as investors, you don't get to look at the current book composition of many of these entities, so we rely a lot on past behavior and their own elucidation of what kind of sort of credit practices that they follow to be able to figure out which are the better ones to invest in. The important sector is a high growth sector. You cannot stay away from them, but one has to be very choosy. One has to pick the right companies, pick the right stocks there.
Okay, just one final question then, Gautam, before we let you go. And I'm just looking at the kind of trend that one has seen from the motor and sales numbers which have come out, and it's, at large, if I have to really sum it up, while case by case, it's a different story altogether, largely you've seen a declining trend, and irrespective of the last few months having the festive season at its peak, it's unfortunate that it's come in this way. Of course, there's been that third-party insurance, crude prices, overall slowdown in sentiment as well, which can be attributed to the declining trend. But do you believe that this trend could stretch itself for beyond a quarter or so?
Well, if you look at this festive season, particularly, two things would have played a very significant role, given that our balance of payments was turning for the worse. That would have really impacted consumer demand big time, especially crude prices. The other thing, of course, was that this festive season was not followed up with a very strong wedding season. The wedding season gets bunched up in Q4. So, and interest rates were high. There was this ILFS related problem where NBFCs would have slowed down on lending. So a lot of things came together at that point of time. It's not that we believe that this is a break of a cycle, because if for that the cycle had to be first very strong. So we hadn't seen extremely strong cycle in vehicle sales, passenger vehicle sales, or even in two-wheelers preceding that. So there were transient issues which have affected. That's our, and we believe that with time many of these things will settle down and the good companies will continue to do better going forward. So that's the hypothesis that we are running. Meanwhile, the stocks have corrected a lot, so we are finding some of them quite inexpensive, and that's the kind of opportunity as an investor you need to wait and take advantage of in these times.
Okay, Gautam, great having you on the show. Thank you so much for taking the time and chatting markets with us.